Welcome, everyone, to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, financial concerns of high-worth individuals around the world with financial industry analyst Don Prinn and wealth advisor Joel Baker. Welcome, everyone. Don, Joel.
Thank you, Steve. Nice to be with you today.
Well, thank you, Joel. Don, welcome back to our show. You've been on before.
Thank you, Steve.
Where'd you meet Joel?
We've known each other for a while. In my firm, we do a lot of research and resource development. And so Joel and I started talking about an area we both think is extremely important to clients. And so we started comparing notes and started developing jointly, I think, some really unique strategies for clients. And so we've been working on that.
But just not any clients, high net worth clients, right? I'm talking worldwide.
Yeah, even worldwide, clients in any country, virtually any country, and also clients not only that are high net worth clients, but also clients that have a significant amount of liquidity.
Now, Joel, you did a survey of high net worth clients all over the world. What did you discover in your survey that made this so important?
Well, the interesting thing was a lot of the important things to international investors are the same as we find with our national investors. They're really concerned about not only their current income tax, capital gains tax, and estate tax, but that they will be increasing because of the worldwide debt problems.
Well, and I would just add one thing. When Joel went out to, and I'll let him answer exactly how many people in how many different countries, but he spent the last several months doing a survey to identify not only the things that different investors throughout the world are worried about, but ranked in order of importance. So we're going to go through this list in a minute, but realize that number one was more of a concern than number 9. I think that's an important point. But Joel, why don't you talk a little bit about who was in the survey, where they were located? There were definitely people from the United States, but go ahead.
Yes, we ended up surveying people in 14 different countries, from China to Argentina, from England, Spain, all over Europe. And our results were very similar, that taxes were the big concern, and then the increased, the government's taking more active role in their businesses, increased regulations. In fact, when I was in China and interviewing the teams that we were playing against in China, they were really excited about Trump. And I go, why are you excited about Trump? And they said, well, because he's deregulating, and that's what we need in our country. We have our governments taking over parts of our farms, our ranches, our businesses, and it's really making it very hard for us to do business. And we hope he's successful, and our governments can learn from that.
Now, when you've done international travel, you did this as a person very involved in the sport of horse polo.
Horse polo, that's correct. I've been playing international polo for over 45 years, and now I'm the U.S. coach for our international teams. 2 years ago, we came in second, won the silver medal
in the world,
and we beat Argentina, the favorite, in Brazil, and now we're getting ready for the next championships in Australia. So I go to Australia in 3 weeks.
Is the same kind of tactical thinking of a coach, is it applicable in the financial world?
Oh yes, very much. You know, the goals, the objectives. We have to, in our financial, our biggest concern is what is our clients' goals? What are their passions? And the same thing with polo and working with the players. What are their passions? What are their characteristics? What are they really good at? And how do you mix and match? And what do you do in money management? We're mix and matching good managers to get the desired results. We do the same thing on a polo team.
Well, you talked about two things immediately, the expectation of income tax, capital gains, estate tax being a problem, and then on top of that, the layer of regulation that really stops us from really growing and doing things. And we're seeing some things now in the United States. Maybe we'll be the vanguard of this. But are income taxes pretty much the same level in the United States as they are in most of the countries that you visited?
It's interesting. The income taxes are surprisingly a little lower, like in China, Costa Rica. Their top rate is down under 30%, where our top rate is well over 39 going up. So I was surprised at how their income taxes currently are a little lower than ours, and their capital gains tax are quite a bit lower. But they're all concerned about those all going up because of their national debts.
Don, we're talking about government interfering, taking over private property. I mean, I think we've seen a little change in our country I think other countries are looking to us now, with Donald Trump being in as the president, that a lot of this is going to start changing.
Yeah, I mean, I think it's important to look at the survey results because, guys like me and Joel, we can't solve problems unless we understand our clients and understand what their biggest concerns are. And so even with what's happening in this country, the biggest concerns are that income taxes are going to keep going up, that regulation is going to keep going up, and that number 3 on our list was that the big concern was that they would confiscate private property. So even with what's been happening in Britain and what's happening in the United States, these clients are not looking out 4 or 8 years. They're looking out longer than that. And so these still are very significant concerns. And in our list, we're still number 1, 2, and 3.
Talking about restrictions of foreigners in the United States, this is the new thing that I've kind of seen. People are wanting to coming back to the United States. We're the dollar, we're the power. And I mean, all this stuff is changing.
And they're worried, Steve. People in other countries who want to invest in the United States, because of the trade wars that are being discussed, they're very worried that there will be lots of rules and restrictions and limitations on investing in the United States.
Well, think about this. We are weeks away, and we're recording in March, where we will hit $20 trillion sometime at the end of this month. The international debt is over $60 trillion, and none of the numbers I've just told you incorporate obligations of pensions, state and federal. I just want you to think about that.
And that's over $100 trillion.
So it's big numbers. We're talking some big numbers. What about the stability of Europe right now? England left. It went through its Brexit. We're looking at other countries that are looking at making judgment call. Just recently, Denmark almost went right nationalist, and so what do you see in the foreign market, especially Europe?
Well, we're getting we got a lot of responses on their concern about the European debt problems and the whole problem, the political problems in Europe. And that made our top 7.
Well, I'm looking at foreign and U.S. government domestic policy changes. It's going to have to change. We have been more towards a socialistic, but that runs up debt. People are concerned about this. And right now, the International Monetary Fund is really calling for all the players, Germany, the United States, France, some of the bigger ones, to really come to the table with more money, and we don't have it.
That's correct.
So how do you see this? I mean, this is impacting regular investors, and people think that the wealthy have so much money to spend, but honestly, they're being hurt the most proportionally to the amount of money that they're earning. So how do we deal with that?
It's a very interesting question. As you're talking about before, when you take our national debt going to $20 trillion, you take our unfunded liabilities over $100 trillion, and if you took all the monies from every one of our 300,000 or 300 million citizens, it'd only be $70 trillion. So we're definitely in a shortfall here, and yet we're not anywhere near as bad as the European countries.
Go ahead.
I was just going to add to that, and that is that there's no question that if you ask most wealthy people in most parts of the world, including the United States, people are very worried over the next 5, 10, 15, 20, 30 years that governments, because of the things you mentioned, the debts and the entitlement programs and all of the spending out of control, they are very worried that taxes, whether they're estate taxes or income taxes, are going to get bigger and take more of their wealth. They're very worried about that, and they're very worried about currency devaluation because of the way that governments are printing money. And so some of the things that we'll talk about in a minute can really help reduce or eliminate current income taxation, but then it can also give people a structure with which to go into different investment strategies that can mitigate currency risk.
Well, when I'm thinking of currency risk right now, which is a huge issue in the euro market, people don't understand where that's going right now. For whatever reason, the dollar looks pretty good. We just raised interest rates again.
Yep.
But for taxes, and I'm talking the trifecta of taxation, income, capital gain, and estate planning, we're seeing a disproportionate amount actually assigned to higher taxpayers. In fact, in the United States, I don't know how it is in Europe, 49% of the United States citizens don't pay federal taxes. That means the onus is on the rest of them, and everybody keeps looking at the top bracket to actually pay the bill.
Well, that's so true. And I have a family in Denmark. My wife's from Denmark, and all of her family lives in Denmark. And they start out at a tax rate, when they start out, first paychecks, 60% income tax.
Doesn't matter what level you're at.
Doesn't matter what
So
level.
it's not progressive.
starts at 60%.
Unbelievable.
Well, and let me say one other thing. At the end of World War II, the tax rate was 95%. So when countries get in trouble, they print money and they tax people with money. So what you're saying is absolutely right. Before we move on, let's just quickly run through the rest of the survey. The mounting international debt and currency devaluation, I think we touched on. Number 6, an unstable European investment client. Number 7, foreign and U.S. government domestic policy changes becoming more socialistic. Again, confirming through the survey everything you've been saying.
Well, when I'm thinking of the next move, probably wealth preservation and reduction or sheltering from taxation, inordinate taxation especially, is probably the next move for Reg D clients and very wealthy clients. And so when we're looking at this, there's only so many moves to make, and you fairly have focused on one specific way to get this done. There's several ways, but this could be a main central area for people of wealth to somehow shelter their money and have access to it in a tax-favored way.
Yeah, it's why Joel and I started working together on this problem, because for years, we've both been focused in the area of reducing income taxes, reducing estate taxes, and asset protection, which is also a crucial part of this. And so for at least 30 years, most countries have tax law that allows some very creative structures that are completely legal and have a long history of established tax policy where investors are able to move their current portfolios and grow them without current income tax, and if they're structured correctly, without estate tax, in a way that's completely asset protected, not only from creditors, but also from government seizures.
The predators of the world.
So we got some really interesting things to talk about for clients that are worried about those issues, and most wealthy clients are, and I think for good reason.
I'm being asked by clients, domestic clients, and some of my international clients, is how can you help protect my castle, my financial castle? I need a better moat to protect me from all these predators. And that's what our wealth preservation plan attempts to do.
Let's walk through some of the big talking points, because I think people are going to say, I didn't know this is even possible. So let's talk about the first one, because this is investments grow tax-free. Well, there's a lot of things in the United States that accumulate tax-free, but they're really tax-deferred. So ultimately, I'm still going to be obligated to a tax bill at the end. But when you talk about it, I think I heard you say, Joel, you're talking about tax-free accumulation, tax-free distribution.
Correct. If structured correctly. We call it tax. Actually, we're accumulating the money's tax deferred, but the way we structure them, using well-proven, that's been around for 100 years, we can pull the monies out tax-free also. So it ends up being tax-free.
Well, and I want to make a really important point here, and that is that you're right. You know, you buy a building and you hold on it for 20 years. That accumulation is clearly tax deferred, tax-free if you die and step off an income tax basis. Sure. This is different, though. What we're saying to clients is, help us understand your current investment portfolio, your current investment manager. And let's say we run into a client who's worried about currency devaluation, and they are doing a currency hedge strategy. Well, as you're well aware, that's going to create a lot of short-term gains, which are going to be taxed at the highest ordinary income tax rates. What we're saying is, with our structure, we can move that investment manager inside of that structure and allow a trading strategy that would otherwise generate a lot of current ordinary income tax to be tax deferred or tax free for years and possibly forever. So it isn't just as simple as saying, gee, there's lots of other strategies. Our strategy allows what would otherwise be taxable strategies to operate in a tax-free environment, which I think is something pretty unique.
Now, not only tax-free from governments, but you say there's some creditor insulation here.
Yes. Yes. Our design and with the panel of experts we have working with us, international tax attorneys and accountants, we're able to structure so they do have asset protection, not only now, but for generations to come. And that's really important to our clients too, is how do they protect their kids and their grandkids.
Now, Don, you said that you could actually incorporate your portfolio, pick your own manager, and you're talking about it's the structure that you're bringing to the table. So if I like my returns, I like my portfolio manager. He has good history. I like what he's doing. I just don't like paying the taxes that he generates. How can I move this over, still keep the same portfolio, the same manager, and move it over to this tax efficient platform?
Yeah, a lot of managers, I mean, the whole hedge fund industry is very aggressive, opportunistic, creates a lot of short-term capital gains and ordinary income because they're going over total return. Well, if you can put that same manager inside our structure, then you can grow those returns tax-free and still let the manager have the freedom of trading in and out of positions that may be opportunistic. So exactly what you're saying. The other thing I would say is, in addition to being able to bring in your own manager that you like or your own portfolio strategy, we also have dozens of alternative investment managers and strategies that you can choose from that are top performers both in the U.S. and the European markets. So those are available as well.
So there's international play here.
Oh yeah, and our international clients, especially in the Pacific Rim, they're not looking for, they like to invest in the United States for security because they're getting beat up, like in China, where they're lost in real estate, they're lost in the stock markets and everything. And they're happy with a lower rate of return if they don't have to pay, if we can keep the taxes out of it, and if it's protected from their governments. And so our process can and does do that, and it allows them to make less risky type of investments and still reach their goals.
And I would say, I agree 100% with what he just said, and I would also say it's true on the opposite side of the fence. If someone said to me, you know what, I've got a certain amount of money, I want to be really aggressive, I want to get 20% of your returns. Well, within our structure, right now, you're going to give up almost half of that in taxes. Well, with our structure, that full 20 keeps working for you. So it works in the conservative side, but it also works great for the client where he has some money where he wants to be in something more aggressive and he's really shooting for the stars in terms of return. It's fantastic for that as well.
Joel, any portfolio limitations on the amount you could do with this?
No, there's no limitations at all how much they can put into our program. And I'd like to also point out that a lot of our international friends that come up and they love it in Florida or love it in California, and they buy some property, and they don't understand that if they die, the U.S. government's going to tax it, estate tax it, from the date they die, with a $60,000 deduction at 40%. And so unless that's set up correctly and monitored correctly, they're sitting on a time bomb.
So what you're saying though is that this is well over the unified credit. That these people have serious money, and so the unified credit's not going to be but a bump in the road.
Well, and let me add to that. If you are a foreign investor who owns U.S. assets, real estate, securities, doesn't matter, the unified credit exemption equivalent is $60,000, not $5 million, $60,000. So effectively nothing. And it's 40% at $60,001. And so if you're a foreign investor with large holdings in the United States, and here's a key point, in the last 15 or 20 years, the IRS has not been enforcing this rule very aggressively. So lots of people who have died have not had the IRS coming after them for 40% of all of their U.S. holdings. What we have found out, though, is that people who understand this, investors from other countries, are very concerned that with what's happening in Washington now, the IRS is going to step up enforcement. And so if you are a foreign investor with significant holdings in the United States, this is something you need to look very seriously at and start to structure against. And that's one of the things our structure has one very unique aspect in that none of it is subject to the 40% estate tax, and you can still hold U.S. assets within our structure. But it isn't. But if you hold those assets directly, that entire amount is subject to that 40% estate tax at the death of the asset holder.
Well, Joel, I noticed that one of the big characteristics of very wealthy people is the aspect of how liquid their assets can be. You could, if I understood your brief, you could build a portfolio inside this structure that would be almost 100% liquid.
That's correct.
So that's a big issue. So we're not talking about long-term, long-haul portfolios and investing, and I got to leave it there and have a hold position. I actually have liquidity, and you could structure your portfolio to get 100%.
That's correct.
It would depend on what manager you chose and what you were invested in. That's more a function. Your liquidity is more a function of where you want your money invested. But if you picked a manager and a fund strategy within our structure that was liquid and available, then our structure would not impinge on that in any way. So you could have it be 100% liquid day one at all times if you picked a fund that allowed that. So
Depending upon the country, and I know this is all,
Right.
remember, there's always going to be different issues
you
here.
bet.
You could take this money out free, even in their country. They could do that, right? They could take their money out of this structure free under their own laws. Is that what I'm hearing?
Really depends on the countries. It really depends on the countries, and they're all really different. So that's why we have this. Our wealth design team works with that particular client in that particular country, so we can set most of the time we can set that up to do that. But like in China, they probably have to go to Hong Kong to take the monies out, or Argentina, very difficult. But yet Uruguay, no problem. So it really depends on the countries.
And in the United States, we can absolutely do that.
Yeah, in the United States, not a problem.
It's part of the reason that our overall team includes CPAs and attorneys that are heavily involved in the process, that are international in their expertise and at an extremely high level. Each client is going to be addressed differently because of their country of origin, because of where their assets are throughout the world, because of their risk tolerances, because of their existing asset profile, their existing portfolio structure. So it's a little more complicated than, yes, it always works. What I will tell you is, and just to answer your question directly, in the vast majority of cases, we can structure this so that in the vast majority of clients, we can in fact do the tax-free structure that you described.
Well, now you said something that kind of caught my eye here. Depending upon the country, you could actually leave investment portfolios to your progeny, your generations, and that transfer could be estate tax-free. No step up in McDish, getting it free.
Right. That's correct.
I mean, that sounds pretty out there to me. So I mean, I'm just saying, you know. So you say generations. I'm thinking, you know, most Americans now are, if we're seeing 3 generations, some of us now 4 generations while we're living, that could pass tax free.
Yeah. The wealth preservation plan is not just one process. It's 5 or 6, maybe in some cases 10, that we've combined and used the best of each asset, of each possibility from each one, and gotten the best out of each one. So it's understanding what's available and then properly mixing them.
Yeah, and I want to add to that, and that is that we aren't doing anything. We're combining some things in some innovative ways. We're not doing anything that has not been done, and any piece of that that has not been done for at least 30 years and has not been implemented by Fortune 500 CEOs, hedge fund managers, venture capitalists, and many, many wealthy families throughout the world.
Presidential candidates.
Well, Joel, let's talk about expenses, because every time we get into any kind of investment, all financial products have costs. They do.
Right.
Are these expensive? Are they modest? What kind of costs am I going to look at to play in this? Because the tax-free could be enough to arbitrate and mitigate the cost, but are the costs pretty expensive?
No, the costs, we're very cost sensitive. So that's why we don't encourage people with under $1 million to use this process, because we want to keep the cost down per dollar put in. And we're in most cases able to keep it well under 2% or under
All
2%.
in.
All in. Everything. And that's equivalent to having a trustee, having it in a trust in Isle of Man or something. So we're very cost, if the cost gets too high in a tax benefit, then you lose this tax savings because you pay it in costs.
Well, and let me add to that. There's definitely, one of the things that we do when we first talk to a client is we're trying to answer the question you just asked, which is, are the costs and fees related to the attorneys and the CPAs and setting up the structure and the annual cost of the structure and all the things that are involved in it, do those costs make sense? And that's going to be a function of a number of factors. One of the factors is, what do they expect their yields to be? And let me give you an example. If you're invested in a portfolio where all you're trying to do is not lose principal, and you're going to target a 2% return, well, this structure doesn't make much sense. When you're trying to get a 2% return and you're paying 2%, that doesn't make any sense. Unless you like our structure for its asset protection benefits, and you're like, I don't care if I make 0, I just want to make sure I don't lose principal. So there's definitely an analysis that has to be done to figure out suitability. And typically, if you're trying to get yields of 5, 6, 7% or more, the costs of this structure are very low relative to the cost benefits of tax-free accumulation and distribution and asset protection.
From our survey pointed out that from our international, from the 14 different countries we interviewed, people in the international, they were more interested in safety than return. Don't lose my money, but I want a safe return. And so a net safe return, if it's over a certain percentage, seemed to be very attractive to them.
Well, and to add to that, let's say you had a foreign investor with major U.S. assets and is listening to this and saying, there's a good chance that when I die, the government's going to take 40% of all of my family's real estate, all of everything we own in the United States. Well, then you don't care that we cost you a couple percent or 1.5% or whatever the number is, because you're not doing it for the tax-free nature of current year's accumulations. You're doing it as a way to eliminate 40% estate tax, and our structure absolutely eliminates it.
Well, a lot of people understand the issue between nominal rates and real rates of return. If I'm sitting at a nominal rate and I'm just paying 200 basis points for all in access to tax-free distributions, maybe I don't care. And even if I'm a conservative investor and I'm sitting there saying I'm happy all day with 6, if I'm netting 6, I'm sitting at a pretty good number, and I'm going to recapture any 2% costs on the tax savings. The higher my wealth is, especially in the United States, the Obama capital gain tax has not been repealed. I mean, I don't know what Donald Trump's going to do about it, but I think he's going to do something about it. But right now, some people are paying some serious numbers at the capital gain rate in the U.S. So I can see all this happening.
And especially if you live in California.
Oh, well, that's a whole other country in itself. Or New York. Any minimum to get into a structure like this?
Yes, we've set the minimum at $1 million. We want to make sure
of
it makes
liquid,
sense. Of liquid
okay.
Liquid investments. And we're looking, and we think a client needs to have at least a net worth of in the 20 million range.
And what about countries? Any restrictions? Pretty much anybody could do this?
There's certain unique restrictions from a lot of different countries, and we feel that all the ones the 14 that we've interviewed, we can provide them the service.
What about the structure of fiduciary backup? I mean, do you have a pretty good team of fiduciary CPAs, tax attorneys, estate attorneys that you've cobbled together as a team to be able to support some of these claims what we're making here?
Yeah, we feel that's very important. And so our law firm has been voted the #1 international estate planning law firm for the last 4 years, based in Chicago. Our accountants we have 3 different major accounting firms working with it, and we have another major estate planning attorney who is an accountant out of Salt Lake who's written a couple books.
All right, so they feel you feel very comfortable that your team, award-winning team, can actually answer some of these questions, whether foreign or domestic.
Yes, and then we insist that the client has their legal people, no matter what country they're in, review and be comfortable with it also, and they can talk with our legal people.
Don, this is all very interesting, as you know. I mean, this is pretty mind-blowing, especially for people who are looking for shelter right now. When you look at this, we have huge national debt. Currencies are in flux. We talked about it at the front end. How do you play against that? Is there any arbitrage or any way to protect my money, especially in these currency changes?
Absolutely. As I mentioned briefly before, what you would do if you're worried about currency devaluation, I happen to be a person that's worried about that. I think that money is, if you look at the last 30 years and the value of the U.S. dollar compared to what it was worth, it's worth a lot less today compared to itself. And I think that's going to continue because of the U.S. national debt and the entitlement program, Social Security, Medicare. And so what you would do if that was your concern is you would look at our structure, and then within our structure, you would pick an investment fund manager that was focused on that currency risk problem. So they're going to be hedging and doing different things that have a growth in your fund if currencies are heading south. So many people are doing that today. Well, all we're saying is do it inside a structure so that you can do it and grow the account on a tax-free basis, because a lot of those strategies create a lot of current income tax and a lot of short-term capital gains, which, it's great to make a 20 or 25% yield, but if you got to give half of it away to the government, you're now at 10. With our structure, you're back up to 20. So.
And just to underscore, we're not talking about this is all after-tax dollars, right? We're not talking about any deductions at all. This is all after-tax dollars.
That's correct.
Okay, so when our listeners are listening to this is a wealth preservation plan, but it's also a tax-free income-generating plan. It has both components to it.
If there's not necessarily,
Oh, really?
but you can do that if you structure it correctly. We do have clients where they only structure it for some reasons we won't get into, but they structure it so there's tax-free accumulation, but not necessarily tax-free income out. And there can be reasons, it depends on their country, it depends on their strategy, but we can do either one in most cases.
Joel, where can they get this plan and get a little information on it?
Well, they can go to our website, jrbakergroup.com/special report, and we'll send them a special report summarizing our survey and the characteristics of the wealth preservation plan, how they could get more information and see if it's appropriate for them.
Well, I want to thank Don and Joel for sharing this segment on financial concerns of high net worth individuals around the world. And keep in mind, before moving forward with anything you hear on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.